Conference to begin.
Our third or fourth month talking to dentists all across the country. We've met a lot of you guys, and we see that the curiosity is strong. So we're going to take it into a couple other arenas this month and get you started. This is Steve LeBroy of LeBroy Insurance Group, and we're going to give it away to Rich Clouse of Rich Dentist, Port Dentist. Take it away, Rich.
Hey, thanks, Steve. It's good to have all of you on tonight. We're November 13th. It's hard to believe we're getting close to Thanksgiving and holiday time. It really goes fast. Steve's up in somewhat chilly D.C. area today. I'm actually traveling down in the Sarasota area, so it's kind of nice to come to you from different venues. Well, tonight the question is, are you ready to learn how the strategies in the books can help you? As you all know, if you borrow money from others, are you building any wealth for you? And we know you're not. We're building wealth for the institutions, and you are losing money for the future. That's why we want you to be the rich dentist side of this, not the poor dentist. We've actually set up an additional spot you can go to on our website, and there's a couple different sections on tax-free income for dentists. And for some of you, that's a long way out. Others, that it's not that long a way out. But the key is, if you're going to want to build it, you need to start building it. So tonight, we're going to review how using efficiency to reduce expenses can help you create more wealth. And we're going to show examples of how your debt can create wealth. Most people don't think debt can create wealth, but it definitely can if you use the Steve strategies and my strategies. So let's kind of get started with it. I guess, first of all, probably a lot of you are going, well, what in the world is that? It's actually a piece of art that my wife and I own. And we met with the artist, and the name of it is Sadness to Joy. And it just hit me in talking with dentists for a lot of years, and in general in life. You know, there are certain times that what you see is things go very well. In a dentist office, it could be everybody's accepting your plans of treatment. It could be that your chairs are full. It could be the hygienists are working great. It can be that all of the receipts, are coming in. The receivables are coming in. Then again, you turn around the next day, and maybe you get a number of cancellations, or you get some credit cards that bounce, or for whatever reason, you change from being very happy and joyful to sad. And I think the key for a business person, dentist running their own practice, or any other business person, is to keep a little more even keel. We know we're going to be happy at certain points of time, but there's going to be those other times that, through no fault of our own, we're not going to be very happy and we're going to be sad. So we got to make sure we don't get too high or too low when we're going through things. Artist is a great guy, very, very creative, very thoughtful in how he puts things together, and this just really hit me in Sadness to Joy. So as we can get going tonight, what Steve and I have kind of decided to do is to take the capitalization and debt management strategies and kind of talk specifically about some of them in each one of these live webinars that we're doing. If you remember from previously, we talked a little bit about club versus swing, and it's a very apropos for the financial world. And the analogy we always do from a comparison standpoint is that if you're talking with a traditional planner, what they're bringing you is, my product is the best rate of return. It's better than whatever you got, buy my product. So in the golf analogy, they're selling clubs. And if any of you are golfers, you know that the driver is the biggest one people talk about. If you can buy my driver, you're going to hit it 300 yards and you're just going to play a whole heck of a lot better. Well, we know that in the golf world, just like the financial world, it's far more important to have a swing coach that's going to help you hit the driver you already have better. In our analogy, what we're talking about is a process and the swing of the financial strategy for you. Once you have that, we can help you pick out a club or a product that'll work. It makes no sense to Steve and I that a lot of planners out there are selling basically products to people with no strategy or no tax strategy. because you're going to spend an awful lot of money in taxes through your career, and we want to make sure you're as efficient as you possibly can. As you know, next, we want you to become the bank instead of paying it to other institutions. Our goal is we want to reduce debts as quickly as possible and as efficiently as possible. And other than maybe practice debt, mortgage, we'd like you to be debt-free in 10 years or less and controlling the dollars. So with that said, let's go into something a little different and kind of what you're going to learn tonight. So the question we always ask is, should you try to get a better rate of return or manage and lower your expenses to generate more wealth? Now, most people would never even think that there's a question there. They would all say, because traditional planning wisdom comes in and says, we want to help you get a better rate of return and handle your expenses somewhere else. That's not what we're here to talk to you about. Our philosophy is totally different. We believe and can show that you can make more money or more wealth by reducing costs, not chasing rates of return. So one of the reasons people wonder a question about the strategy a little bit is that they're going, well, if we're putting money in the conservative 3, 4, 5, 6% rate of return, how can we generate as much wealth? Well, the key is when we can reduce costs, we're going to show you how you're going to free up money and have more money working for you to create more wealth. So as I said, the traditional planners want you to give them your money. They can invest it, and they make you more money, is what they're telling. And they're there to do a good job for you. We're not saying that they aren't. But what they provide is a macroeconomic advice. And the only thing they're really talking about is your investment account. Our belief is that you need to look at everything in a macroeconomic planning phase. And what that means is the traditional planner cares only about the account they're talking to you about. They don't care what you may be doing in your 401k plan at work. They don't care what you're doing legal-wise in making sure your estate is set it up right. They don't care what you're doing in your life insurance. They're concerned just about the investment account. So the micro planning is a very traditional way that most people have multiple advisors that aren't working together. What Steve and I do is we talk about having a quarterbacking job. We think you need to look at your final financial life and all the decisions together in one thing. That doesn't mean we have to handle everything because we don't need to, but we need to know what people are doing so they don't have to go off in one direction that's direct opposite of another direction. So having it all put together from a macro standpoint and reviewing it that way is really important. Okay, so here we go to kind of look at some numbers tonight. There's going to be a lot on the screen, so bear with me if you can. Our kind of income data we're looking at a 35-year-old making $150,000 a year, expects income to grow at 3% a year, so pay raises, and the annual earnings rate is 5%. Now, this one is maximum potential. This is not realistic because what that says is if you were saving 100% of your money, you would have basically $21 million at age 65, 35 years out. Well, I don't know about you. I know Steve and I for sure have never had our parents say, hey, we can give you all the money you want to live on. Save every dollar you make. Would that be wonderful? But I don't know anybody that's happened to. So this maximum potential just gives you an idea of with that amount of money flowing through your checkbook, you would have the potential to have $21 million. So the key in what we're going to look at tonight is how can we look at that and see what basically changes with what happens to us in life. So we've added one element, to this. All of this is the same. All we've added in taxes in this. Now, taxes at 35%, people might say, geez, that's way too high. Think of it as income taxes, maybe state, city, federal, real estate taxes, cell phone taxes, any kind of taxes that you can think of. So that number can be a lot higher. Some people think it could be a little less. I don't think it could be much less when you add it all in. But at 35%, the key here is you would have paid $3.1 million in income taxes. but your actual loss was almost $7.5 million. The question Steve and I always will ask is, how in the world it only cost you, get that word, $3.1 million in taxes, but you lost $7.5 million? Well, the term is called lost opportunity. Boy, my writing's not too good, sorry. Cost. So what happens is when you spend $1 today, you not only lose the dollar, but you lose all the growth on that dollar also. So even though you only wrote checks for $3.1 million, if you didn't earn the interest on a dollar you wrote here in 2018, then that dollar lost all the potential growth it would have on it too. So there's a lot on this, but you can sure see the graph as it goes up. It stops a little close earlier on this one, and the red starts growing down here. So let's go to the next one, which is just continues to add what life is really, about. So in addition to taxes, we've added in 2 other pieces. Same information over here. The debt service, 35%. That's an average, a national average of what we run through our checkbook that goes out for debt service, whether it be mortgage, credit cards, cars, student loans, practice debt, all of those things together. So by the time you do that, you can see that you're only really saving 5%. So now look what happens over here. Your $21 million, if you had no expenses, has dropped down to $1.3 million. Now, if you were retiring here in 2018, if you had $1.3 million, it might not be too bad. But if we're looking 35 years out, I think most of you would agree that that's not exactly what you would want. And see what's happened to the graph? A lot of red and not a whole lot of green left. Now's the case, and we talked about it a little bit earlier. When a traditional planner comes in and wants to talk to you about your investment, if you're only going to have $1.3 million here, they've got 2 different things that they can show you or ask you. First one, they'll say, can you save more than 5%? And most people go, well, if I ever get done paying all those things off, maybe I could, but I can't. So the next way is they're going to say, well, I can get you a better rate of return on all your investments than 5%. So let's go out and try to get a better rate of return. So that's going to be the next piece we're going to look at. This is going from that, is it better to chase rates of return, and will that create more wealth, or is it better to manage your expenses to increase wealth? So as we go to the next one, see the difference right there. So it's an 8% rate of return. So one of the questions we always ask is there more risk? Are you taking more risk trying to get an 8% rate of return than 5% rate of return? And the answer is clearly you're taking a lot more risk. Some of the best money minds in the world, including Warren Buffett, Tony Robbins, and others, their whole mantra is never lose money. Well, they realize if you're taking risk, the more risk you take, the more opportunity you have to lose money. What a lot of people don't realize is going from a 5%, trying to get a 5% rate of return, to going to an 8% is a 60% additional risk that you're trying to take. And I think all of you would agree, if I'm taking a 60% higher amount of risk to try to get a better return, I need to be a little careful in what's going to happen there. But let's look at that. At 8%, you have the 5% that is still going to savings because you couldn't save any more money. Well, look what happens. So 35 years from now, it's gone up to $2.6 million. Now, again, is that better than 1.3? Yes, it is. But you're taking a lot of risk. This also assumes that it would be a 8% every year, year in and year out, with no losses. What about a day ago? The market went down 600 points. Well, this assumes that it never went down at all over that period of time. So even in that you picked up another $1.3 million, it may not have worked out exactly that way because we're going to have those days and those years where we have some losses. But it does create more. Now, let's look at what we think and what our philosophy is on the next screen. We reduced it back down to 5%. So what we're trying to do is here, how can we help you manage those costs? Well, what if we can help you reduce taxes by 5%? Now, there aren't a lot of different things that you can do these days to reduce taxes. A lot of people say, well, Rich, I can put money into a 401k, a simple plan, or an IRA. And Steve and I tell you, you're not reducing any taxes in. You're just choosing to postpone those taxes to be paid at a date in the future. As an example, if you put $10,000 into a plan and you were in a 30% tax bracket, your accountant would probably say you just saved $3,000 in taxes. We didn't save $3,000 in taxes because you had to write a $10,000 check to not have to send $3,000 to the IRS. So you didn't save any taxes. In fact, you had to write a $10,000 check not to write $3,000. So you actually wrote a check for $7,000 more than you would have needed to. But there are a few ways that we can help you reduce the taxes, legitimately to where you get to keep the money. The debt service is where we can have the biggest impact. If we can reduce that from, say, 35 down to 15%, you can see what happens to your lifestyle. You're now saving 25% more. You've reduced the lifestyle, or you've saved money in the other areas, so you're saving 30%. So look what happens now over here. Now, even at the 5% rate of return, and how much risk is that? A lot less than 8%. You'd have $6.8 million, $6.6 million 35 years from now. That's significantly better, and the question we always ask, did you take any more risk? We didn't take any more risk because if in that cost ratio, please, if you wrote the checks to Uncle Sam for 35% instead of 30%, would you ever get any of that money back? If you wrote the checks for the debt service, another 20% going to the banks and the equipment companies, et cetera, would they have ever given you their money back? No. So you've taken no risk. You've just improved the amount of money you're able to save, and using even a conservative 5%, you're creating significant more wealth. You can see how much better the green looks and how much smaller the red looks than in our other scenarios. So kind of to get this kind of in context, what this is really saying is you can make more money by handling your expenses and debt more efficiently than you can trying to chase a high rate of return. All right, next screen basically is we get a lot of questions on, well, okay, if 8% didn't get you more money, what rate of return would I have gotten every year to maximize that? So here we go. 11.66 rate of return every year without a down year you would have needed to get to that 6.6 million. So when people say this concept doesn't produce wealth and doesn't provide great rates of return, I think most people out there would say if I could average 11.66% for the next 35 years, I wouldn't blink an eye and I'd do it. Well, that's what's handling your debt management, can do for you. So chasing rates of return isn't the answer. It's the efficiency and the modeling of how we can help you get out of debt and save those dollars that are important. So hopefully this brings a lot in, and that's when we talk about the maximum potential is handled much more efficiently by expense management than it is by chasing rates of return. Okay, so as we go to the next page, and we're getting a little close on time tonight, but not too bad yet. We've looked at this before. If you've read the book before, you've seen it. But what I want to do is go over it in context of what we just went through. I want to reiterate again. If we've got a CAP plan and we've got cash values and we're using those cash values to pay off student loans, practice loans, equipment loans, credit cards, etc., we are using the insurance company's money. And when you use anybody's money, whether it's the bank, the equipment company, the government for your student loans, you have to pay those people to use their money, and you pay them interest to use their money. But with our strategy, properly done, you can recover all of it or some of it. So I want to spend some time going through this, maybe in more time than we've ever looked at it before. So here's our example of a 35-year-old male. Now, in this example, we use $50,000 per year that they're going to fund with for all of our examples here. Now, don't worry about the $50,000. We've got people putting a lot more money in than that. We've got people putting a lot less money in than that. The concept is more important here. So if that 35-year-old never used the money for any of these strategies that Steve and I are talking about, they would have $685,000 at age 65 in the account. Now remember, that's growing with no taxes against it, totally tax-free. They could have used the money, but in this example, they didn't use the money. And when they want to take it out at age 65, they've had a very safe, secure building with guarantees in the contract. Now, we don't believe that that's what we ought to do. We believe you should be able to try to drive a better rate of return and more wealth by doing that, by taking it out and handling your debts better. So our first example over here is 5 loans at $100,000 per loan. So $500,000 would have been loaned against the policy in this example. If we paid it back at 6%, that tells you the monthly payment would be $1,933. So over those 5 loans, you would have sent $579,000 back to the insurance company. $500,000 of it was your principal that you took out, which means you sent the insurance company an extra $79,000. So what did you get out of that? Basically, your $685,000 of cash value grew to $747,000, almost $747,000. So what does that really mean? That means it went up by $61,000, which is 77% of the $79,000. That means you recovered interest that you paid the insurance company to use their money. You recovered 77% of it. But more important than that, right up here, you've recovered all your principal. And the question we ask everybody is, if you've done it traditionally, equipment companies, banks, are you ever getting any of your principal back? And everybody knows no. And for sure, they're not paying any of the interest back. No, we all know they aren't going to do that either. So even if this number was 0, if you had all your principal back and you could have used it for that basically 30-year period, wouldn't you be in better shape? There's no question about it, you would, because you would have had control of the money. So now we get asked the question a lot of, well, why should I pay it back at a higher rate than I have to? If the insurance company is only charging me, say, 5, why should I pay it back higher? The reason is because you can make a lot more money. So here's the example, the next one. If you chose to pay a loan to your practice and you chose to pay it back at an 8%, we have a lot of our dentists that go, wait a minute, at 6%, it's $1,933. At 8%, it's $2,028. If I can afford $1,933, I can afford $2,028. So what happens across this? You paid $608 back, the same $500,000 of principal. You gave the insurance company an extra $108,000. But your account went up by $107,000 over what it would have been if you hadn't used it at all. So you recovered basically 99% of the interest you paid to the insurance company to use their money. If you go to 12%, again, we're not saying early on in your career the difference between $1,933 and $2,224 isn't a lot of money, but when you're running a full-blown practice, that isn't a big difference on a monthly basis for a lot of the dentists to do. So now we were at $689, so it went up, $891, it went up $206,000. So you ended up getting 123% of your interest back plus all your principal. The last one we always put in is 16%. And effectively, we see some of our dentists around the country that will lease equipment. And in many cases, in leases in most states, they don't have to give you what the interest rate is on a lease. Now, there's an imputed one, but they don't have to give it to you. But you can kind of work backwards to see what it is. And in many cases, it's anywhere from 14% up to 23%. So if you went out and got a third party that gave you a leasing agreement, it was at 16%, and you had the offer from them that showed that, you legitimately could probably charge your practice 16% to loan the money. And if you ever got audited and you had that third-party offer, you would have a good chance of winning something against the IRS in there. I can't tell you you're going to win for sure, but I can guarantee you one thing: if you didn't have the retail at that 16% out there, you would have a prayer to win, because they were going, this low-rated environment, you just charge too much. So in that example, it's $309,000 extra money, 135% more. So what this is basically saying is, what you want to have is you want to charge your practice as much as your CPA feels comfortable that you can charge it, to be able to drive as much extra money for you as possible and create, in this example, $309,000 more tax-free dollars that you can use to help supplement your retirement. Again, this is one piece of it. This isn't sure the only thing that we're doing for our clients. We've got clients that have $2 or $3 million in these types of policies too. We have other ones that have $40,000 or $50,000 if they're getting started. But what our goal is to help you be as efficient, drive as much wealth as you can in a tax-free basis, and then we can kind of go from there. Okay, we're about running out of time here, so let me kind of get the last page again. Here is the website. As you know, you can contact me directly, and we will set up a personal, complimentary 30-minute meeting with anybody that wants to, and we can talk specifically about your situation, and Steve and I will run that, and we are very accommodating from a time standpoint of what locale in the country you are and what time we need to make. Well, Steve, we got time for a few questions. Why don't you cue some up for me?
Sounds good. It's been a good presentation. One question that came in direct to me was about cost, and they must know a little bit about the cap plan, probably from the book. If the cap plan costs 5% to use the money, and I only pay myself back 6%, is it worth it?
That's a great question, and to be honest with you, 15, 20 years ago, this one tricked me up also. But what you have to look at is, if you have a 5% cost and you're charging 6%, that's a 1% difference. I used to think I was only making 1% when I charged my practice 6%. The difference is, what rate of return is 1% on 5%? My cost was 5%, and I made a 1% profit. It's a 20% rate of return, not a 1%. So when you're thinking about putting money back out in the marketplace to invest, in this case, it's all on your ability and your wherewithal to pay yourself back at that 6%, and you're driving a 20% rate of return on that. So it's well worth it. But what else you got, Steve?
Got another one. It says, people say rate of return in a cap plan is not good. Why not invest in regular investments?
That's another great question. It really relates just to what we talked about here. Let's say instead of 6%, it cost you 5%, but you loan the practice back at 8%. Again, that's not a 3% rate of return, because 3% on 5% is a 60% rate of return. So the leveraging technique of being able to use the cash value takes the predictable, say, 4 to 5% rate of return and turns them into multiple rates of return because of the leverage that you can do with it. So that is fairly risk-free if you're loaning it back to your own practice and you're in charge of paying it back, because you do like yourself better than you like the bank, so I'm sure you'd rather pay yourself more and create these kinds of rates of return for you. We'll see. We got time for one more.
One more. All right. Here it is. I'm going to choose this one next. Since needing to pay principal and interest to the banks and equipment companies that basically are saying, hey, we're paying principal and interest to the banks, why use the banks at all? Why even go there since this is so good?
That's another good question. And if we were all independently wealthy and could have all the money in our cap plans we want, we wouldn't have to use it. But it's really, really important, I can't stress enough, to have a good relationship with the banks, because for a long period of time, you're going to need them. because you're not going to have $500,000 or $750,000 or $1.2 million. And if you build multiple practices, there are going to be a lot of reasons you need to use them. So having a good relationship that we can take and get a loan from them, and then using the strategies with the cap plan and the cash values typically, and I've talked to a lot of bankers about this because I've got a lot of bankers that are really good friends of ours because we work with them so closely around the country. They don't care if you pay it off early. You know, the banks make their money early on when they loan you the money. Either they sell the servicing. So if we have an 8-year loan and we can help you pay it off in 2 or 3 years, it's very beneficial that the banks were there to help us get started, because without them, you're not going to have enough money to make that big purchase. So we clearly need to have them. We need to keep on good terms with them. We need to provide them the information that they need, but then this strategist eliminates the need to use them for as long as we originally thought there. Well, Steve, I think that's all the time we've got tonight. I want to thank everybody for joining us. As you know, we'll send out the copies of this. Hopefully the sound and everything else works, so if you want to listen to it again, you can. Don't forget to head out to the website and look at some of the new stuff on the tax-free out there, and there are some of the videos we've done before, and the podcasts are all out there. You can listen to them at your leisure. Again, don't hesitate to call Steve or I to set up your complimentary personal 30-minute meeting, and we'd love to have an opportunity to help you. And we'll talk to you next. We'll probably do one in December. I'm not exactly sure when with the holidays, so we'll try to get one done for you. So thanks a lot for joining us. We'll talk to you all later. Thank you. Okay, Steve, you too. Bye-bye.
Bye-bye.